Good morning. You're watching a live market outlook for Friday, 18th of November 2011, prepared by Windsor Brokers. The main world's problem, Italy and Greece, are showing some results as Italian new government has announced far-reaching reforms in response to European debt crisis that on Thursday pushed borrowing costs for France and Spain sharply higher, and brought tens of thousands of Greeks onto the streets of Athens. The Italy's new technocrat Prime Minister Mario Monti unveiled sweeping reforms to dig the country out of crisis and said Italians were confronting a serious emergency. The Monti, who enjoys 70% support according to the opinion polls, comfortably won a vote of confidence in his new government in the Senate on Thursday by 281 votes for and 25 only against. He faces another confidence vote in the Chamber of Deputies, the lower house, on Friday, which he also expected to win comfortably. On the other side, in Athens, at least 50,000 Greeks joined the protest rally, presenting the first public test for a new national unity government, also headed by an elected figure that must impose spending cuts and tax rises in Greece if Greece is to escape the bankruptcy. There was a clash between police and protesters in Greece that the people were shouting Eurozone and IMF out of Greece. The Spanish government was forced to pay the highest borrowing costs since 1997 at the sale of 10-year bonds with yields at steep 1.5 points above the average paid at similar tenders this year. The Euro remains under pressure and fell in response as France fared a little better, but again had to pay markedly more to shift nearly 7 billion euros of government paper. Fears that the Eurozone's second largest economy is getting sucked into the debt mainstream have taken the two-year-old crisis to a new level this week. The euro and the sterling remain in the sort of consolidative mode in the past 24 hours after hitting fresh lows. However, the sentiment, wider picture sentiment, remains firmly negative, and both currencies under pressure, as well as commodities that gold fell to the levels of 1,700 per ounce after hitting $1,800 per ounce last week, while crude oil completely erased the latest strong rally through $100 per barrel barrier, extending gains over $103 per barrel. And yesterday's fresh fall dipping down to $98 per barrel zone, completely retracing the recent gains. Dollar yen comes again under pressure after a couple of days of steady directionless trading, dipping down below the initial support at 76.80, while dollar Swiss holds the bullish tone, currently in the corrective mode after a strong rally through 92 barrier, extending gains to 92.34, fresh high posted yesterday. From the other side, in UK, there is the members actually of members of U.S. Congress Deficit Reduction Committee considered scaling back their efforts on yesterday amid the Republican split over taxes and mounting doubts of reaching a deal by next week's deadline. The 12-member super committee has until midnight, heads until midnight on Wednesday, the day before the Thanksgiving holiday, to reach a deal to cut U.S. deficits by at least 1.2 trillion over 10 years, voicing the sentiment of many on Capitol Hill and other aides said it doesn't look particularly promising, but there is a place that works deadline to deadline, and then they will see how the things will be developing. From today's calendar, quite a few of events. German PPI monthly released already, showing a 0.2% raise compared to 0.1% forecast and the 0.3% previous month release. Across the ocean, Canada monthly CPI is forecasted to drop by 0.1% versus 0.2% previous month release, while the monthly core CPI is expected to drop by 0.2% versus the previous month 0.5%. Also, leading index from Canada due at 13:30 GMT forecast 0.2% versus minus 0.1%. Pardon. Canada leading index, minus 0.1% the previous month release. Back to the markets to see the latest developments in the majors and commodities. Starting with euro, on the hourly chart we can see that studies are in a rather negative, in a neutral tone after hitting fresh low at 134.21. This is just ahead of strong support of weekly Ichimoku cloud base at 134.07. Significant for this study is that basically the pair during this year hasn't broke below the Ichimoku cloud, as the latest, the previous spike low to 131.45 was also contained, and this gives significant support to the pair for possible further extension higher. Of course, this is from the technical point of view, while fundamentals still keep strong pressure on the single currency, as the debt crisis is attempting to spread through the Europe, and as I mentioned earlier, the France is now under pressure. The current consolidation is seen held below 135.40, 135.50 previous highs, and basically only break here is to signal some stronger recovery. Above this, we have a stronger barrier of 38.2 Fibonacci retracement at 135.70. And according to the news from the market, strong selling signals would be coming, and offers will be coming from this level. Also, the 50% Fibonacci retracement at 36.15, where also comes the main bear trend line drawn from 142.46 high. And holding below here keeps the current movement, marks the current movement as consolidative and corrective ahead of fresh weakness. On the downside, the loss of 134.21, 134 strong support zone would open way for a further extension. 133.70, 60 zone is actually the last barrier ahead of key short-term support at 131.45, which is the low of 4th of October 2011. On the upside, as I mentioned, only break above 136.15 would provide a near-term relief and open way for stronger correction of the latest downleg from 138.10 down to 134.21. The British pound is also in the corrective mode. The gains were limited by previous high at 158.14. That yesterday's attempt also failed here. However, today's fresh attempt briefly broke above 158 at 22 was seen until now, but overall outlook remains in the negative tone, while the hourly studies are now gaining some momentum and looking for further extension higher. This would be also seen as a corrective. As above here comes immediate barrier at 158.42, which is the 38.2% Fibonacci retracement of the latest down leg from 168 to 156.90, the low posted in early hours of yesterday's day. Basically, we need to see clear break above 158.15 and 158.40, which is the 38.2% Fibonacci retracement, in order to signal stronger. However, the wider picture studies are still in the negative mode and favoring further weakness of the pair, as well as daily studies that are attempting now. MACD is attempting to break below the midline. It's already below the signal line, and the momentum is hovering around the midline, keeping the negative outlook still in play. Current attempt through 55 days moving average on the daily chart might signal some stronger recovery, but while below 159.70, where is the 20 days moving average, currently turning to the downside, we'll keep this in the corrective category and await for the fresh leg lower. Only break above 159.70, 160, which is psychological barrier, might signal the higher low at 156.90 and the refocus levels at 161 zone, 161.33, which is the 200 days moving average that currently caps the upside. The dollar yen is losing traction after several unsuccessful attempts through 77 barrier, resulted in the fresh weakness through 76.84 and 76.80, which is the low of 14th of November, and it was the recent range floor. And further losses, the brief break already hit 76.67, and further losses expected to test initial supports at 76.50 and 76.30 next, while the near-term studies are firmly now into the bearish negative territory and keep the downside favored. On the upside, hourly 20 days moving average currently at 76.92 is maintaining the recent weakness, with only break above 77.15 to ease the current bear pressure and to possibly open way for test of the strong barrier spike high at 77.50. The dollar Swiss remains in the consolidative mode after a strong rally from 89.51, the low of 11th of November. Succession of higher highs and higher lows resulted in the fresh high at 92.34 seen yesterday, with the corrective action seen supported by 91.34 zone, which is previous lows and the previous high of 10th of November. Also close to Fibonacci 38.2% at 91.25, and holding above these levels keeps the recent bulls in play for attack higher. On the upside, clearance of 92.34 high opens way for test of the upside key barriers 93.13, the high of 6th of October, and 93.38, which is the high of 27th of March 2011. Daily studies are also firmly in a bullish tone as the MACD recently breaks above the midline and holding above the signal line, keeping the upside favored. The commodities are at the back foot, as we can see. The gold on the daily chart is attempting through 90 and 55 days moving averages already broken, and 1710 was seen so far low ahead of our strong support at 1700, which is also 38.2% Fibonacci rate of the rally from 1532 up to 1802, and the further extension lower is not ruled out at this point, as the studies are approaching their midlines, and loss of daily moving averages would signal extension down to 1680 as a low of 1st of November, and then 50% Fibonacci retracement at 1667. On the short-term outlook, the hourly and 4-hour studies are firmly in the negative field, with the initial resistance at 1762, low of 10th of November, and the 20 days moving average at 1735, the previous support now acting as initial resistance, and 1755, the 20 days moving average currently maintaining the recent bear tone. The crude oil has fully reversed the recent strong rally. It started from 98-99 zone and extended up to 103.35, also breaking above our all targets 100, 160, and then we had 103.36 that was actually tested. The immediate outlook turns into the negative territory, as the hourly studies are already in the bearish field. However, the current recovery is attempting through 20 days moving average ahead of 99.80 and 100 barrier that might signal some stronger corrective action. 4-hour studies are still in the positive field, however pointing still to the downside, and the downside remains vulnerable. The low at 98.05 remains vulnerable at this point, as 99.80 20 days moving average currently limiting the upside. The break here in clearance of $100 is to signal basing attempt at 98.05 and possible fresh attack higher. The broader outlook for crude oil remains firmly bullish, while 200 days moving average at 95.51 is intact and currently underpinning the rally, as well as 20 days moving average that's currently attempting to break above 200 days simple moving average on daily chart to give the golden cross signal for a further extension higher.